All right, so let's get into this presentation, the US government debt and your portfolio. Right before we jump into it, I want to show you guys a slide that I think is incredibly relevant for today, for this presentation, and I want you to keep it in mind as we move forward through this presentation. So this is a slide covering the US government debt. Many of you are probably blatantly aware of the levels of debt that the US is in. Currently, the level of debt is at about $3.14 trillion. This is obviously, I'm sorry, I apologize there. The debt is $31.4 trillion. This is an incredible amount of debt. We've never seen debt like this before, and it continues to grow rapidly. The US government spends per year, they budget about $103 billion just to maintain this level of debt. That's about 11% of the federal government's spending in 1 year. So it's a lot of money to keep spending just to increase the debt to spend more. All right, so let's cover the content of what we're going to talk about today. We're going to be talking about the US debt environment and its current state and its future state, maybe a little bit of what kind of brought the US to where it is today, and what, even from the government standpoint and budgetary aspects, where the debt environment is going to go in the US. Then we'll talk about the development of the US dollar, how it has developed up until this point, and the effects of debt on the US dollar and moving forward. Then we'll talk about how an independent asset manager may be able to help you that might fit the situation, your financial situation. And then we'll talk about offshore investing from our perspective at WHVP. All right, as we jump into this, I would like to introduce myself a bit more to you. Obviously, my name is Jess Roberson, as you can see on the slide. Here at WHVP, I take care of a lot of administration tasks for our managing partners, as well as implementation of marketing strategy and planning with the marketing team. And I help the investment team with a bit of research, so that kind of encompasses my role here at WHVP. I also, in my free time, what I like to do is I play rugby for the Swiss national rugby team. I really enjoy pushing myself to the limits and improving myself. I also love nature. As you can hear, I am an American. I married a Swiss girl. That's why I'm here in Switzerland. I grew up in Colorado. I love the mountains. And so for me, Switzerland is a similar paradise. And I love visiting the mountains with my family. I studied at the Southern New Hampshire University, where I got my degree in finance and international business. Currently, I'm fluent in, my mother tongue is English. I've learned German since being here, and also the Swiss German dialect. All right, enough about me. Let's jump into this presentation. So here is the US debt environment. As you can see by the slide, this is the graph here. This is the federal debt held by the public, spanning from 1940, as well as with the projection for the next 30 years from today. As you can see, that's an incredible increase of debt. The US did seem to bring it down during World War II. There was a lot of spending going on. However, since the 90s and 2000s, really, it's been an ever increasing debt burden. So to give it a reason of why we're in the situation we are today, in 2020, the Federal Reserve, in order to prop up the economy and markets, bought about $2.3 trillion of Treasury securities just in one fiscal year, which is an incredible amount of cash that was put into the market, that was taken up and handed out. The US government in those years to handle the pandemic spent $19.2 trillion from 2020 to 2021. And actually, it's about 2019, about the end of 2019. So you have to count for that as well. So about 2 years, really 18 months, a little bit more than 18 months, the US government essentially spent 3 times the amount of what they would spend, 1.5 times the amount of what they would spend. They spend per year about $6 trillion. In general, that is what previous governments have been spending. And just in 2 years, they spent $19.2 trillion. All of this, or much of this, was paid with or financed with cash, credit and debt. And that's where you see that huge spike in 2019 to 2020. It's an incredible amount of spending. If you look at the deficit, which we'll get into just a little bit later, the federal government has been expanding their deficits of what they've been able to take in revenue versus what they're spending. They continue to increase the deficit to increase the spending of what they're doing. They just simply can't take enough revenues in for the amount of spending that they're doing, and they plan on spending into the deficit, knowing that they're not going to take in the revenues from taxes or other revenue streams. So currently, according to the United States Treasury Department, the debt to GDP ratio is 124%. So essentially, the amount of debt held by the US government is 124% of the amount of value that the US economy pulls in 1 year. This is an incredibly high number. There are countries that have higher, but considering that a healthy amount of debt, of government debt, goes away at about 77% of your gross domestic product or GDP. So all of the benefits, debt can be beneficial to economies and the participants in those economies, but after 77%, all the debt above that really starts to weigh on the population, weigh on the economy, weigh on the currency, and really drag it back. So what was the deficit in 2022? Very clear, $1.4 trillion. So this was after all the COVID pandemic spending that's starting to recede. I guess you could say the markets were going back to normal, and the US government still spent $1.4 trillion over what they had planned. I think what's interesting here is the debt ceiling that the US uses was raised by the current administration to $31.4 trillion last year at the beginning of 2022, and they expected that the government wouldn't hit that debt ceiling, or their spending wouldn't hit that debt ceiling until the end of 2023, October, November time. And now we are approaching that with Janet Yellen, our Treasury Secretary, informing the new Speaker of the House that the US government would be to that debt ceiling by the end of January. So we're way ahead of schedule, and the debt is ever increasing. So there's going to be some big movements in the next couple months so that the US doesn't default on all the debt that they already have, and they're going to have to raise that ceiling again. So moving on, we have the debt environment of the future. What does the US government plan to do in the future? If we look back at the history in this federal deficit trends over time, over the past 20 years, roughly, you can see spending has significantly increased. There were some years where it started to recede. However, whenever there's an economic downturn, the United States government lets everyone know that they're there to help and spends more money, increasing the debt levels that the US is holding. So the quick facts are the federal spending increased by 50% in response to the coronavirus pandemic between 2019 and 2021. So an incredible amount of spending to deal with that issue. The last government surplus was in 2001, so where the government didn't have a deficit, where they actually made money on the year. That was $130 billion, where this is a lot of money, certainly. It doesn't compare to the between 23 and $25 trillion gross domestic product. Still good. We always like to see making profits, but it's very far and few between. If you look at the last 50 years of the United States and how the government has run their finances, and their budgets, they've only had a surplus 5 times in 50 years. Not a lot. The US government seems to continually run on excess spending and deficit spending, which has to be financed by debt. And again, with the ever increasing debt levels, it will continue to pull on the economy, on the people and the population, and the currency, the US dollar. So in the last slide, we showed you the expectation of the US debt levels. And actually, over the next 30 years, they expect the US debt level just held by the public to go from where it is today to over, which is 124%. They expect it by 2052 to be 185% of the gross domestic product. This is the projection of the United States government. This is their budgeting office. And they plan that, or they expect to see a 7.3% increase on an annual basis to the deficit for the next 30 years. So obviously, they don't plan on slowing down much. They actually expect that by 2052, the annual deficit in their spending will be up to 11%. So they have no plan on slowing down their spending. They're going to continue it for the foreseeable future, and this is going to ever increase the burden on the U.S. economy, the value of the U.S. dollar, and those who participate in it. It's not to say that there aren't good things, but it doesn't look like a good period in the future. So when you look at this current chart, what I think is interesting is you see these crazy spikes in 2020 and 2021, and then a drop in 2022. It was touted by a lot of government officials that they were spending less than previous administrations. But if you see it, they actually just went back to normal spending of what it was pretty usual before, and if not more, pre-pandemic than what was being spent pre-pandemic. So yes, they were right. They are spending less than the previous administration. However, in the trend, they're spending about as much as the previous administrations did before them, with respect to all political parties involved. And so again, this is something that's going to continue, sadly, irrespective of who is in control of the US government, from what it looks like on the outset and what the US government is actually telling us through their budgeting office. So how has the US dollar developed? 2022 was actually a really good year for the US dollar in terms of the strength that it gained in comparison to some other currencies. Obviously, there were huge economic impacts of the coronavirus, the war in the Ukraine, as well as bottlenecked issues that were exacerbated by the Suez Canal blockage, as well as China being shut down. There were huge global pressures on economies, and the US dollar seemingly did well as people from other countries looked to find the US dollar. The war in Ukraine actually bolstered the value of the US dollar, and the embargoes on Russia seemed to have some effect on the US dollar as oil was traded in US dollar, the prices went up. There's a strong connection. Also, the hawkish Fed policy. So from the beginning of 2022 to the end of 2022, there was an increase of about 8.29% of the value of the US dollar. Inflation was high, hitting almost close to 9% throughout the year. However, it did go strong. However, there were points in the year where the US dollar was actually up almost 17% on the year. And when the market sentiment changed, the US dollar lost its value very quickly. At the end of the year, I mean, up until almost September, the US dollar was flying high on strength and gain against other currencies, against a basket of currencies. And at the end of the year, when the pressure kind of came off, people realized there was some political turmoil in the US, some economic pressures that were coming that weakness started to go away, and people in the investment market started looking for something outside of the US dollar. And you saw the incredible drop of the US dollar at the end of the year. It's something that has continued to drop. Actually, in this chart, if you look, it says 106.27. This is the US dollar index. It's currently today, it's at 101.5. So it's dropped even further since this presentation was created about 2 weeks ago. So, there's a lot of changes in market sentiment, and there's a lot of pressures. With things opening up, we can see that the US dollar in the long run is going to continue to trend down. If you look at the value of the US dollar back in 1985, it was sky high because of hawkish Fed policies then, even more hawkish than we see today. And unless the US Fed, or unless the Federal Reserve really keeps pushing up those interest rates, we don't expect to see the US dollar gaining a ton of value in the long term. And in fact, we see it losing value. So now, what is the future of the US dollar? I think this is very important to look at in the broad context of since the 1930s. So how has it developed almost over 100 years? You can see that it continually trends down. Since the 1980s, there was severe drops, and it's leveled out a bit, but the trend continues to drop. There is no uptick in that trend significantly, and over time, decade to decade, it loses value. If you look at other currencies, they don't have these same patterns. One example is the Swiss franc, which has actually gained value against the US dollar. Even if we just go back 10 years, if we go back 20 years, it's actually gained more. If we go back 40 years, it's gained more. So there's a huge value in looking at other currencies that might be performing well based on their economy and what they're doing, where portions or using your finances, your portfolio, to make some moves for the long term that might be successful in the future. But everything else, we have to be very careful with. Investing is always a bit of a risk. However, with educated and informed decisions, you can really set up a strategy that works well. So we don't see the US dollar really a future in it gaining serious value. We don't see in the global environment the US having or the US dollar having a real desire by the global economy for having it become too strong or too weak. However, it's something that has to be looked at quite closely in general. So to give an example of where we kind of see why there's going to be some loss in the future of the US dollar is, first, inflation's still running incredibly high. It might abate a bit, but it doesn't seem like it will be within healthy levels or even at the target levels by the end of 2023. So we're going to have another year, 3 years in a row of high inflation, higher than the target inflation. The Fed's monetary policy is driving the current strength of the value against other currencies, but as that tapers back, you've lost a lot of value through inflation, and then the value of the US dollar against the Baxter currencies might go down as well. We'll have to see. That could be the outcome of some weakening of the monetary policy as far as raising interest rates. Further, government spending is not going to slow down. It's actually going to increase, and they're going to use debt to increase their spending. That's not a good outlook for the US dollar. That's not a good outlook should there be a point in time where the US dollar or the US government has to default on their debt. It's not happened to this point. If it does at this amount of debt, it's catastrophic. So it's something that just poses a risk, period. Even if the US dollar holds its value over the next 10 years, if the US can at some point pay its debt, it's going to cause serious problems for the US economy. And yeah, it's something that poses a great risk to wealth being held inside of the US, because you never know how the government will react or how markets will react. Excuse me. And so that's something that needs to be considered when setting up a portfolio investment or a portfolio that's solely in the US. It can bear a lot of risk just from the US government debt. And finally, I mean, you can see even in the 80s, it had lost, the US dollar had lost a lot of value, and it's never recovered since then. And that's just a span of 40 to 50 years. So it's something that is certainly concerning. So now I'd like to move on with what can be done about this. What can we do to make a difference, or how can I set up my portfolio to mitigate some of this risk that's it's facing if I have a portfolio that's almost entirely in the U.S. and U.S. equities, bonds, or only held in U.S. dollars? What can you do to mitigate some of this risk that the government debt poses to the economy, to the currency, and your portfolio? First is search for countries with healthy debt levels. Pretty plain and simple. When you look at an investment, often one of the factors you look at is how does a company, how do they manage their debt? Do they manage it well? Are they increasing it? Are they holding it stable? Can they pay for their debt? Can they pay for their short-term debt? Can they pay for their long-term debt? So looking at countries with healthy debt levels is a great place to start, to look at, are they a healthy economy? Is their economy working? As an example, I'll just talk about Switzerland. Switzerland, unlike the US, has a different debt ceiling level. So in the US, the debt ceiling is set by a number that's currently $31.4 trillion. In Switzerland, it's actually set at a percentage of the gross domestic product. So however much the Swiss economy is able to generate, their debt limit, or their debt break, is set at 43% of, they can accumulate debt up to 43% of what their gross domestic product is. What this causes is it makes sure that the government is effective in spending their money, that it's allocated properly, and that they're not increasing crazy amounts of debt to pay for spending programs, and they make sure that what they are spending is effective, and it's actually going to what it's supposed to be allocated to. If you look at just not just debt levels, but the inflation levels, Switzerland, year to year, or year on year of 2022, their inflation rate was quite high. Actually, it was at 2.9%. This is about 1% higher than their target. Switzerland has a target range between 0 and 2%, but clearly not as high as the US, and they've been working to really bring it down and have done a good job at that. So finding a country with a healthy economic environment is kind of the first place to start, to look at what can I do? Is there a place that offers some value? Then is position your portfolio to mitigate the domestic risk, the domestic government debt risk. What that can be done is diversify your wealth structure. So move parts of your assets to that financial jurisdiction so that it can benefit from that economy. Hold stable foreign currencies. You know, is there a good exchange rate? Exchange it into another currency and hold them. I think what's interesting there is the Swiss franc is an incredible safe haven currency, and it's actually against the US dollar. It's over the past 10 years, it's held its value completely. And if you go 20 years, it's actually gained value against the US dollar. And so there's a long-term positive effect of even just holding currencies. But again, identifying those currencies takes a lot of time, a lot of research, and understanding the economy that's in, understanding how the monetary policies of the government are, or the fiscal policies of the government are, and what the monetary policies of their central bank is. And so there's a lot of research that goes involved. And finally, it's creating a nest egg in a financial jurisdiction. Creating a nest egg outside of your domestic economy, in this case, the US, will give you the chance to really kind of push it into, push a bit of that risk away, create something that can counterbalance some of the risk that you're holding in the other portfolio. All right, so now this is what you can do. I want to talk about working with an independent asset manager, what that's like, what it offers you, what you have. So first, you have an independent partner. Going to a bank and working with an investment bank is good. It can bring value, certainly. However, banks often create products, and they want to push those products, and so your investment account might be holding products that are actually paying the bank even more. And it might not be the superior product. It might be a great product, might not be a great product. But having an independent asset manager as a partner, they really get to look specifically for what is the best and what's going to fit your financial situation, what's your portfolio. Then you have personalized service. This really comes into the business understanding who you are, that you're their target audience. They understand they're SEC registered so that they make sure that everything is taken care of, that they understand your needs. They can really build something around who you are. They understand how Americans think and can really build that relationship through great service, through personal connection, and through their ability to understand the market that they're in, the environment that they're in, for the investments. Then you have the direct access to owners. Often independent asset managers are very small, and you have direct access to the owners. For us at WHVP, if there's ever an issue, you can connect directly with our owners, and often are connected with our owners from the very beginning of the process. And this helps in solving problems. If there's issues or anything happens, there's a lot of leverage when the owner of a business is able to work on your behalf. Then you have continuity. Going to a private bank, you like your relationship manager. That's awesome. But the services at the bank are maybe subpar and you want to switch banks. Now you have to build a whole new relationship with a whole new relationship manager at a new bank. If you work with an independent asset manager and you build that trusting relationship with your relationship manager, and the bank situation just doesn't seem to fit, the custodian bank is maybe offering or changing something, you can switch custodian banks and keep the same relationship manager. So you really get to have that continuity of building that relationship, building that trust over time. Then you have the focused specialization. They are really able, the independent asset manager is really able to know the market that they're in, especially when you're moving assets out of your own country. And they get to know who you are. There's a lot of connection that they have to the US. And it just helps to really refine what you're getting versus at a bank where they have an investing department that's here and there, and they have to watch the whole market. You really get the whole global economy, which independent asset managers certainly watch the whole global economy, but they're able to really get involved and understand the ground roots of what they're doing and what the purpose of the portfolio is that you have or are desiring. Then you have the choice of custodian bank. As we kind of mentioned, there's the independent asset manager will set up contractual agreements with various custodian banks, and you get to choose which ones you want. Let's say you want multiple accounts. You can have multiple accounts and multiple custodian banks with the same relationship manager. So it gives you a lot more options and allows the independent asset manager to give you suggestions on what's going to work and what's not going to work. Then you have lower account minimum sizes. So the initial investment doesn't have to be $1 to $3 million. It can be as low as $250,000. And so it really allows more access into the private banking sector and the investment banking sector than would be going to a bank directly. Then there's a broad network of partners, which the asset manager brings to your fingertips for all of your financial service needs, whether it's setting up a trust or a PPLI. You can always find something that could be helpful by asking your independent asset manager, and they can hook you up to a specialist that they've built a relationship with and know they work well. All right, so now let's move on to the setup, what it looks like. Just quickly, an overview. The client is obviously the pinnacle of the relationship. The asset manager works with a limited power of attorney with the client and has already set up a contractual agreement with the custodian bank. However, the client does the account opening, meaning they're the ones, the client, you own the bank account. It's yours. The asset manager only works with a limited power of attorney to help you manage the account. And this allows you to get the best of both worlds. You get someone on your side who has some leverage with the bank because of the contractual agreements and knowing the bank, as well as someone who understands the processes of the banks and can clarify things when you're opening that account. At the end, it's all your account. Everything is yours. It's simply a limited power of attorney that allows the asset manager to help manage the account. So what are the benefits of the offshore bank account? We talked a little bit about this before with geographical diversification. You get to move assets to another financial jurisdiction that maybe is more politically safe. The economy is more stable. The currency is valuable. It just allows for that separation to take some risk out of all of your finances being held in one jurisdiction, beholden to one government's debt or political risk or economic risks. It really allows for the diversification to become more physical. That can really bring a lot of added benefits of even the financial jurisdiction having different laws, which we'll cover in just a bit. You have a different portfolio emphasis outside of the US dollar. It's very normal for investment advisors to be heavily invested in their domestic economy because it's what they know, it's what they grew up with, it's what they're saturated by in the media. And this allows for a chance to really focus a portion of your portfolio in a different direction and outside of the US dollar, so you can gain the benefits of the global market instead of just the US. The US market only makes up about 46% of the global economy, which is massive. So we're not saying get out of the US market. There's a lot of opportunities there, but it's leaving a huge percentage, over half of the rest of the economy and the opportunities that exist there. So again, it allows you for that different portfolio emphasis. Added layer of asset protection. The laws in Switzerland are very strict on confidentiality. You are not, as a financial institution or bank, private information of the client cannot go out of the bank under punishment of incredible fines and criminal charges that can lead to imprisonment. That's the Swiss Banking Secrecy Act. So banks are very safe in terms of privacy protection because of the consequences that it would play on them. So it helps to keep nosy neighbors and people who are frivolous lawsuits away from your money. That said, the caveat is if you have done something illegal, there is an actual legal claim against the finances. The Swiss government courts will hold up the court ruling. However, often for the money to be pulled out, people have to come and travel to Switzerland to even get that, even with legal, like physically come. And so there's a huge mountain of work that goes into even a legitimate claim of where you illegally did something to pull assets out. Otherwise, no one is going to know that you have assets outside of it, other than the people that you tell and the reporting requirements that you have to do to the IRS, which is something that the US government has placed on American citizens as a requirement to report. Then you have the enhanced privacy protection. Because of these privacy laws, cybersecurity in Switzerland is incredibly high. The private banking sector spends a lot of money on making sure that everything is very safe and secure, so that no information comes out. And then you get protection against an inflation-ridden US dollar. I mean, the US dollar, even in years when it's in a good percentage range, it's around 2% year on year, and that adds up over time. And you look at the Swiss franc, it has experienced inflation at a much less rate. Even over the past 10 years, they've had 5 years where they were lightly in deflation, 0.2, 0.4% in deflation. And over the 10 years, essentially, the currency has not had inflation wreck it, even considering the high inflation that they had in 2022. All of this allows you to have overall stability of a portfolio. And that can really help in challenging times and when the market and governments are going crazy, when it just allows for that stability to be settled into your portfolio. So what are the challenges of an offshore bank account? We want to be transparent always with our prospects, our clients, our business partners. So we want to talk about the challenges so that you understand what you're getting into, what you think about, what happens when you move portions of your asset offshore. First is using the private banking sector. It costs. It's not your sign up and get a free toaster deal that a lot of banks in the US run. These are investment accounts, not retail accounts. And so it costs a percentage of what's being held at the bank. It's just a reality, and it's not exorbitant, but it is something that you notice. Then you have the paperwork that's involved. There's a lot of paperwork for U.S. Citizens moving finances offshores. However, it's totally manageable, especially when working with an independent asset manager. They walk you through each step of the way. We do with our clients. We walk them through each form to make sure they understand what needs to be done, what the form is about, that everything's in English. So there's nothing hidden. It's all very clear and can be done quite smoothly. Then it's finding a competent partner, doing your due diligence. That takes time, even when you're looking for an investment advisor in your own city or neighborhood. And when you're doing it overseas, with an overseas investment advisor, it's more challenging, but it's still very possible with the internet age and the technology age. Find a competent partner. You can do a lot more due diligence. You can find reviews on them. You can look at their websites to understand what they do. You can look at their licensing. Are they SEC registered? Are they not SEC registered? Can they be my investment advisor? And even emailing them, reaching out to them is much easier than before with Zoom and phone calls that have made the connectivity much more accessible to you to really start to find who you want to partner with, who you can trust, and who you can build that relationship with. Because of that, you do obviously have the time and geographical distance that exists. And there you just have to make sure that there's a little planning ahead of time. Emails kind of help with that. So there's a little bit of administration work in it, but it's very possible to do. So I want to talk now about the investments of what we at WHVP invest, how we invest, what we're focused like. So we are long-term capital preservation strategies. That's what we apply. We want to hold the value of your wealth over a long period of time while it grows, but certainly ensure that there's reduced risk as much as possible. We exclude the U.S. market and U.S. dollar investments. So using WHVP, you won't have U.S. dollar investments, and you will get out of the U.S. market so you can benefit from the opportunities that exist away from what your portfolio is most likely holding the most in. How we do this is with direct investments in stable economic environments, with stocks, equities, bonds, precious metals, and foreign currencies. How we go about selecting this is kind of a top-down approach with our investment team, where we first look at countries and the currency, and we assess how is the country's political situation, what's the volatility, what does their central bank do, how do they manage its currency, what are the potentials there, what is the country strong at, do they have a viable future, have they performed well in the past. Then, once we've highlighted countries that we think are going to be valuable and going to offer opportunities, and their currency is going to offer an opportunity and value, then we look at what is that country good at, in what industry do they perform well at, what are the laws in that country that support that, what is the feel in the country of the population about those industries, how have they performed just in general at doing what they do. Once we find those attractive industries in those countries, then we look at the companies, which ones perform well, which ones have potential, how is their corporate governance set up, how do they manage their company, what's the business models, and then really into the technical detail of the investment opportunity, how the company itself is managed, and what is the future of that company. So that's kind of our investment process in a rundown. Now I'd like to tell you about our services quickly. Just so you understand what we do. I'll start here in the middle with asset management. Our asset management, we name all of our services after mountains in Switzerland. So first is our Eiger right in the middle. This is a tailor-made portfolio, and you get to choose when you take this service. You get to choose the custodian bank you want to work with. We obviously give recommendations. The minimum account investment for this account is $500,000 US. The fee for this account is 1.5% annually. Here, it's important to say that we really work with you to build a portfolio around what you have already invested. We don't want to double up investments. We want to make sure that your overall portfolio is matched to what you would like to do moving out of the U.S. This service comes with quarterly calls where we communicate with you. It's our most popular service. Moving on to DOM, our concierge level service. This is a concierge service, so you get a lot of bells and whistles with this. The minimum investment size is $1 million US with a fee of 1.5% of assets under management annually, and then a flat fee of 10,000 Swiss francs a year. What this comes with is, again, we personalize the portfolio for you, as well as ensuring that you get the choice of the custodian bank that's going to fit you and fit what you need and the services you need, as well as it comes with 24 hours of concierge service, totally free, meaning you want the new Rolex, we'll try everything in our ability, free of charge, to get that Rolex to you with all the financing, payments, everything. We take care of it. And then it comes with a yearly visit, personal visit, where we fly to whatever country you're in, and we speak with you and we meet with you. Finally, we have our Pilatus, our permanent portfolio. This is a standardized portfolio. It has a moderate level of risk. And this minimum investment size is 250,000 US with a fee of 1% a year. This is not a personalized portfolio. We've set up and selected investments that fit a very good diversification for someone who wants to start diversification. And it really allows you to understand what investing or diversifying outside of the US dollar can do. It's a really great service. I want to say with all of these services, they're available for personal accounts, joint accounts, individual retirement accounts. So your IRA, you can move that offshore. It's totally legal. Trusts, LLCs, and foundations. So there's a lot of opportunities here. And through these services, you can have multiple bank accounts, and the fee will stay the same regardless. So let's move on to the process of how you'll set up. I'll try to get through this quickly as we're hitting our time limit here. So first starts with an email, usually, where you reach out to us and let us know you're interested. We set up a call or video meeting where we discuss your financial situation and what the potential is to work together. It's a mutual decision to work together. We have to choose you, and you have to choose us. It's a trust business, and that has to be built from the start, and that's a mutual decision to reach that. In that call, we can decide the service, the bank, and an account type of how you're going to set up the portfolio. And once those decisions are reached, then we get some information from you so that we can present you to the bank. And that's some background on who you are, your working experience, background on finances, how you generated your wealth, your address, your residence address, and your passport copy. With this, we can go to the bank and get the account opening documents from them, and we bring those back to you and work with you to get those completed. Once you get those completed, they're sent back to the bank. The bank then goes through their compliance checks and opens the account, and the account is ready to be funded. Once the account is funded, through that whole time, we're working on investments that are going to fit you and what you need in the diversification, what you want in your portfolio. And that's when we have our initial investment call, where we talk about the investments we've put together with you, and we discuss them with you and your thoughts on them and how you think they're going to fit. And then once the decisions are reached that you're okay with those investments or you want some changes, then we start to invest. And then there's ongoing communication, where we love being in communication with our clients. Emails back and forth. We set up phone calls once a quarter or 2 times a year or once a year, depending on what you want. We always make sure that we're in contact with our clients because we think it's important. You get online access to your bank accounts at all the custodian banks that we work with. And so we want you to ask us questions, and we want to keep you updated with. And to do that, we also put out a market, an environment, economic environment market analysis every 6 weeks, so that you see how we're thinking, you see what we're paying attention to. And again, we love communicating with our clients. Phone calls, emails, back and forth. We want to make sure that you are well cared for and taken seriously. And we love getting questions, whatever you need. So finally, we're going to talk quickly about the tax considerations for Americans. We're not tax specialists, but there are requirements that we have to be aware of and that you have to be aware of. First is the U.S. tax reporting. You have to report your bank accounts and the taxes that you have, or the tax repercussions that you have in your account, capital gains and whatnot, as well as your FBAR, the accounts held outside of the U.S. Then you have a withholding tax that's taken in Switzerland. This withholding tax is taken when on the dividends and coupon payments. However, the majority of it can be reclaimed at the end of the year, which the custodian bank does on your behalf, which is good. So you get the majority of that back, but it's something you need to be aware of. Then you have Swiss turnover taxes, which are small taxes levied on the purchase and sale which are levied on equity investments. These are very, very small. However, you need to be aware of them, that they do exist. And finally, investment considerations. We look at the purpose of gaining the best long-term tax benefits. So we're not looking to buy something and sell it 2 weeks later on a gain, or sell something that's going to increase your tax burden. We really want to make sure that what we're doing doesn't affect your tax burden too much. So that's kind of what we do. That's what we look at. But again, we're not tax specialists, but we do consider these things, and you need to consider them as well. So I'm a little bit over time, but I've come to the end of my presentation, and I want to thank you guys for all participating and joining along. And now would be a great time to put those questions in the Q&A bar if you have any questions. You can visit us on our website to learn more about who we are at whvp.ch. We have a blog that we update once every 2 weeks. There's a lot of really good content on there. If you're interested in what we're writing about, we try to keep our social media quite active, so you see what we're doing, what's going on, what we're interested in, and what we're seeing. We actually have a podcast. You can go and listen to podcasts to get to know us, see our faces a bit more, our managing partners, and see what we're interested in. We have a YouTube page. You can find us on LinkedIn and Facebook and Instagram. You can see our email there. If you have questions, you want to send us emails. Should you have any qualms, you can't click on these now, but I'm going to send this presentation out to you in PDF form, where you can follow all of these links here. So if you guys have any questions, go ahead and write them into that question bar. I'll give it a little bit of time to see if anyone has any questions. Right. So that's a great question. The question is, if I open up an account and I should die or be incapacitated, how is that handled? So in Switzerland, how it works is someone in your family would reach out to us and tell us that you've passed away, and we would then tell the bank, at which point the bank would block the account, so there can be no outgoing transactions. No one can take the money out. Then your heirs will have to provide your will and testament, a notarized copy of your will and testament, the death certificate to prove that you're dead. An original works the best, or a notarized copy, but original will work the best. And passport, a notarized copy of their passport to prove their identity, that they have rights to the account or have rights to the finances held in the account. And with those documents, they can be taken to the bank. And once that is, it's checked by the compliance department and everything's in order with the legal paperwork, the account can be unblocked, and you can get your heir can continue to work with WHVP or with the independent asset manager, or close the account or withdraw the account. But that's kind of the process of what happens in case someone, if you were to be incapacitated while your portfolio is open in a foreign account. So must these documents be original copies? The documents as far as the will and testament, or the documents as far as the opening of the bank account. So I'll talk. So the will and testament, it can be a copy, a notarized copy with the original wet signature on it of the notary. That's okay for the bank accounts. Perfect. All right. So yes, the documents. So the documents that are filled out, what usually happens in an account opening process is we will get the digital copies. All the information that's needed will be filled in, passed on to you, and you will complete them with a signature. Usually what we like to do is then have you send a scan back so we can quickly check that all the signatures are in the right place, that everything is filled out correctly, that we can, working with you to make sure that's all right. And once we see that it's all good, then you send those documents in original form with your wet signature on it back in the mail to us. And once the bank has them, then everything is in order. The account can be opened. So yes, the documents need to be an original copy. For instance, however, when you're providing information, I'll give an example. We talked about the information that you have to give on your background. So often what that is a CV or a source of funds, how the wealth was generated. Those don't have to be in original form. Your passport copy that's notarized, that will have to be in original form so that the bank can see that it's you, certified that it's you that's opened the account, and the bank documents themselves have to be set in original form. Some of the extra information can just be in digital form, which helps. But yes, the documents have to be sent in original form via mail. Yeah. Will notarized copies do for references? Is this the question is references of like character references? Is that in the context of like I guess your resume or reference letters? You don't have to have a notarized professional and bank. Yeah, your professional references don't have to be notarized. They don't have to be sent in original form either. Digital copies of those work just fine. When you consider the bank, notarized copies don't really work because the bank needs the originals to actually open them. But what can be done is making copies for yourself, or even when it comes back to the bank and they put their signature on it, they can give a copy back that we can give to you. So the notarized bank form wouldn't be possible, but as far as a professional, your CV, even how the funds were generated, those don't have to be notarized at all. They can just be sent even digitally and passed on to the bank. All right, so here's a question. Another one is, can I open an account, an IRA account offshore? And how does that work? So yeah, you can open an IRA account offshore. What has to be done is you have to work with an IRA administrator that's based in the US. We work with Advanta IRA. They're a fantastic IRA service. And so you open up your account with them, and an IRA account with them. And then we work with Advanta and you to open up an account, investment account in a Swiss bank or Liechtenstein bank actually, to have your IRA then placed into it. So it goes through the IRA. This allows the IRA administrator this allows your IRA to be held offshore, and allows for it to be diversified, which is a really cool option that you can even diversify with your retirement account. If you're afraid of that, or you want to move that into capital, or afraid of what the U.S. economy, or afraid of what's happening in the U.S., you want to move that offshore. That's possible and totally legal. It's actually a really good option, and it's really awesome that they have that set up here in Europe, in Liechtenstein, and the laws are set up in a way that allows you to do that. All right, I'll give it maybe another minute or so for any final questions of those of you who are here, and then I will sign off. So I'll just give it a minute or two if anyone has any questions. Put them in now. Just as a final thought, if you have any questions or you want to contact us, speak to one of our relationship managers, just send us an email. And I hope to get this presentation out to you guys by tomorrow morning. It's the end of the day here, so I probably won't get this out tomorrow, but I hope to have it to you guys in email form tomorrow with all the slides. Yeah, so thank you guys so much. It doesn't look like any more questions are coming in. Thank you for participating. I really appreciate you guys taking the time and sitting down to hear what we had to say on the U.S. Government debt situation and what you can do to reduce the risk of a portfolio held solely in the U.S. By moving offshore. All right. Thank you guys. Have a wonderful, wonderful rest of your day.